Yeah, thank you, Bob, for that introduction, and thank you to the Vancouver Board of Trade for hosting this event. I'm delighted to be spending International Women's Day here in Vancouver, which is a city that's long been a leader in fostering diversity, tolerance, and inclusiveness. Another event of International Women's Day was earlier today in snowbound Halifax, where Governor Stephen Poloz and Finance Minister Bill Morneau unveiled the new $10 banknote, which features a portrait of the late Viola Desmond. Now, Viola Desmond's story is a very inspiring one. In 1946, Ms. Desmond, who was a black Nova Scotian businesswoman, refused to leave a whites-only section of a movie theater in New Glasgow, and she was jailed, convicted, and fined. She confronted this discrimination with grace and courage, and she made history, bringing forth the first notion by a black woman in Canada. Her case was an inspiration for change and part of a wider set of efforts towards racial equality across the country. The banknote will begin circulating later this year. I hope you'll agree that its images and symbols, and you can see the design of the note, reflect the progress we've made as a nation and the road still to be traveled in pursuit of human rights and social justice. Now, I'll turn from those lofty themes to the topic of my speech today, which is Canada's continuing economic expansion, which has brought the Canadian economy close to its full potential. This is a setting for the monetary policy decision which we announced yesterday. And for those of you who may not know, we make 8 decisions on the policy interest rate each year. Now, 4 of those come with a publication of our monetary policy report, which has a full forecast of the economy, both the Canadian economy and the global economy, and it also has a detailed explanation of how we see the various risks to our inflation outlook evolving. Now, when we publish that monetary policy report, then the governor and also the senior deputy governor appear in a press conference, and they answer questions for the media. And we also have other presentations. Some of you have been to presentations that I or one of the other deputy governors have given when we've come to Vancouver and other places to talk about that forecast. Now, up until today, actually, the other 4 decisions that didn't carry a monetary policy report were much briefer exercise, and they'd only come with our press release, which is about a page long. So we've now decided that starting today, one member of the Governing Council will be giving a public speech, which is called an Economic Progress Report, a day or so after each of these 4 interest rate announcements. And the idea is to shed further light on how we see the economy evolving and the considerations that figured most prominently in our deliberations. So today's speech then is actually kicking off a new initiative, and it's another step in our ongoing efforts to help Canadians better understand our actions and decisions as Canada's central bank. Now let me begin. The Canadian economy is broadly progressing very well. Following a decade of many setbacks, 2017 was a year of robust economic growth, 3% for the year as a whole. After many years in which Canada's economic growth was uneven, it has been becoming more balanced. The material slack that existed in the economy, and especially in the labor market, has been largely absorbed. Inflation is running close to our target of 2%. While the future is subject to notable uncertainties, which I'll be discussing, trends over the past few quarters have been quite encouraging. The trends have been broad-based across regions and across sectors. But these favorable economic conditions are particularly evident in certain parts of Canada, and here in BC, I think we have to say this is one of the areas of the greatest strength. Of course, Canada is a very open economy, and its growth is supported by what is now a synchronous global economic expansion. This, too, is encouraging. We're now seeing solid growth not only in the US and China, but also in Europe, as well as in many other emerging market economies. The U.S. economy has been on a path of mostly solid growth and job creation for a few years now. At the beginning of 2018, the data indicated stronger momentum for the United States, and the tax cuts announced just before Christmas were expected to boost demand in the U.S. even further. Developments since then have largely supported this story. U.S. economic growth remained robust at an annual pace of 2.5% during the fourth quarter of 2017, And the U.S. economy is now essentially at full employment, with the unemployment rate now down to a 17-year low. Wage growth has also been edging up in recent months, and meanwhile, U.S. business confidence remains high. And increases in government spending, which were legislated in February, are likely to provide a further boost in the next couple of years. The U.S. economic picture still has even some upside potential, as the current expansion could create a virtuous circle, triggering animal spirits among businesses and consumers and driving even faster growth than expected. If that happened, stronger business investment and household spending in the U.S. would likely also boost our economy. So as always, we are watching developments in the United States very closely. On that note, we saw some sharp movements in U.S. and global stock markets a few weeks ago, ushering in increased market volatility, as you can see here. And here I've got a slide which shows the red line at the bottom is a measure of market volatility, which you see spikes up in that period in February. And the green line in the middle is market-based expectations of inflation, and the blue is long-term interest rates, which reflect, to some extent, market expectations of where monetary policy in the U.S. is going. Now, while these shifts were clear, the shifts in the markets were clearly amplified by some technical factors, and of course markets are always prone to overreaction, the repricing also reflects a shifting economic outlook. Market expectations about the path for inflation in some major advanced economies has been shifting upwards. In the United States, for example, where inflation had been persistently running short of their target. The shift in expectations about inflation and the strength of the global economy bring forward, to some degree, market expectations of less stimulative monetary policy, and you see that in the upward shift of long-term bond yields. So over time, rising bond yields in the United States can be expected also to put upward pressure on yields in Canada, and we've started to see that a little bit. In effect, as markets digest what the changing dynamics could mean for central banks, markets themselves are bringing up about some of the tightening that would be consistent with an improving global economy. The rise in volatility came after a long period of exceptional calm in global financial markets, not just in stock markets, but also in fixed income markets. That tranquility, reflected at least in part of monetary policy, are starting to diminish, and where more normal levels of volatility may be returning to markets, and increasing protectionism. I'll talk a little more about that uncertainty in just a moment. Turning back to Canada, as I've said, 2017 was a year of robust growth for our economy. We were expecting growth to moderate to a more sustainable pace going into 2018, and the last National Economic Accounts data confirmed that it has. In fact, growth of real gross domestic product in Canada during the fourth quarter of 2017 slowed more than we'd expected in our January forecast. But even as the annual pace of growth came in at 1.7%, which is compared with our forecast in January of 2.5%, the underlying details suggest that the economy is actually progressing pretty much the way that we expected it would. Specifically, what we economists refer to as final domestic demand actually increased at about a 4% pace for the fourth consecutive quarter. You can see that here on the slide. Show continued growth in what Canadian businesses and households and government were spending around that period. And so a lot of the fluctuations in the headline growth numbers actually reflect partly a swing in the fact that imports surged, and the surge in imports reflected strong business investment, which actually adds to the economy's capacity, so that's generally a good thing. And there were also, of course, some temporary factors influencing imports during the last quarter. In addition, housing and government spending were actually contributing more to economic growth in Canada than we'd previously expected. So on that note, we'll also be incorporating the implications of the recent federal budget into our projections for economic growth in Canada in our April projections, which will be coming out in a few weeks' time. So we haven't actually done that math yet, but that's something we'll be releasing in April. All that said, uncertainty about the North American Free Trade Agreement and growing global trade tensions will need to be watched for their possible impact on the outlook. Recent developments with respect to steel and aluminum, despite the encouraging news that David referred to a few minutes ago, alongside heightened protectionist rhetoric, can potentially carry quite serious economic consequences. We do not know how or when the NAFTA talks or other trade disputes will be concluded, and we do not know how industries or governments will react. The range of possibilities is quite wide, and that means that trying to quantify any scenario in advance would not be particularly useful for monetary policy purposes. For now, our working assumption is that existing trade agreements will stay in place over our current 2-year projection horizon. As and when concrete outcomes emerge, we'll be in a better position to assess their impact on the Canadian economy. But even with no changes in our trading arrangements, the uncertainty around them is affecting businesses' investment decisions. The U.S. tax reforms may further reduce the relative attractiveness of investing in Canada. For both of those reasons, firms may decide to an increasing extent to redirect some of their planned investments from Canada to the United States. Our economic projections have been incorporating the judgment that such effects are likely to dampen business investment in Canada. As we prepare for our April forecast, we'll be assessing whether the degree of caution that we've applied in that regard is still appropriate. An important indicator we'll be looking at will be our Spring Business Outlook Survey, which is a reflection of interviews and questions with businesses, and that's something we'll be publishing on April 9th. There are a couple of additional points to note on the export and investment picture. First, with respect to energy exports, spot prices for crude oil have fallen since we published our January forecast, but they remain relatively high compared with most of last year. But as you can see in this chart, Canada is not seeing the full benefit of oil's recovery because of the wider than average differences between benchmark global oil prices and the benchmark prices for Canadian heavy oil. To the extent that those differences stem from ongoing transportation bottlenecks, we expect them to persist. They could have a dampening effect on investment in the energy sector in Canada. In addition, although Canadian manufacturing activity has been solid in recent quarters, non-energy goods exports could disappoint again, given ongoing competitiveness challenges. Indeed, in 2017, these challenges meant Canada was unable to benefit fully from a strengthening in global trade. Another key element of our economic outlook is household spending, consumption, and residential investment. In our January projection, this spending was expected to remain solid while contributing less to growth as we go forward. But there are a lot of moving parts. Speaking to a Vancouver audience, I don't need to tell you that. The effect of various provincial government measures in BC and Ontario are still working their way through major housing markets. Federal authorities introduced new mortgage underwriting guidelines, which came into effect on January 1st, and higher interest rates are also expected to dampen household spending. This effect, the effect of household interest rates of higher interest rates is likely to be stronger than it has been in the past, since the average household is now more heavily indebted than before. The timing of these effects can vary and is hard to predict. For example, we expected that some home resale activity would be pulled forward into the last quarter of 2017 as buyers and sellers tried to book transactions before the new underwriting guidelines took effect. The strong pace of resales late last year and the recent sizable drop, which you can see in this slide, appears to be consistent with that kind of pull forward idea. But it's really too early to tell how these measures, and not to mention the measures that the BC government announced just 2 weeks ago, will affect housing markets over the longer term. We'll have to just continue watching the data closely. And we'll also continue to assess how sensitive consumption is to higher interest rates, given high household debt. On that front, it's worth noting that household credit growth has been decelerating in recent months. It's still too early to firmly call that a trend, and credit data can be quite volatile, but it's what one would expect to see given that interest rates are moving a little higher. Turning to labor markets, despite a fallback in January, Canada has made considerable progress in job creation over the past year, as you can see in this chart. And the chart is actually comparing the gains in full-time employment to the job creation that would have been needed just to keep the unemployment rate constant. So we've actually been making up some ground vis-a-vis the natural growth of the labor force that's going on. So the jobless rate in Canada is consequently near a historically low level. Wage growth has also firmed, but it still remains lower than would be typical in an economy where there's no labor market slack. Going forward, we'll be monitoring the extent to which the minimum wage increases in several large provinces may be affecting broader wage pressures. For now, it's a bit early to say what impact those measures will have. So meanwhile, even as regions such as British Columbia are experiencing wage pressures and intensifying labor shortages, for Canada as a whole, the elevated long-term unemployment rate and the relatively low youth participation rates suggest that there's still some slack in the Canadian labor market. Reflecting this, the bank's composite labor market indicator, which is intended to capture broader labor market developments, has fallen by less than the unemployment rate. Now I'd like to go into a little bit more detail about inflation, both globally and in Canada. I mentioned earlier that recent developments in global financial markets would seem to reflect shifting expectations, in fact, an upward shift in expectations about the path of inflation in the major advanced economies in the US and elsewhere. Only a few months ago, the fact that inflation in those economies, including, well, not just the US, but also the Euro area and Japan, was either slowing down or remaining weak, despite the material slack that was being absorbed in the economy, was causing some people to question whether the inflation process might have structurally changed. And at the global level, there are a number of possible explanations for why inflation has been relatively slow to pick up. For instance, there may be more slack than people thought there was. A second possibility is that inflation expectations may have drifted lower in response to persistently low inflation. The competitive effects of the rise of a digital economy and ongoing globalization may be playing a role in holding down prices. Or it may be simply a matter of time, observing that inflation never sort of picks up smoothly and doesn't follow a mechanical process. So our staff have been working hard to assess these and other possible explanations. To date, they've found no compelling evidence that the underlying inflation process has changed globally. That's not to say it hasn't. We still need to continue to study this, but for now, our view remains that the key relationships between inflation and other underlying economic conditions remain intact. Given the depths of the post-crisis recession and the varying degrees of slack in different economies, it's not that surprising that inflation has taken longer in some countries than others to materialize on a sustained basis. Meanwhile, here in Canada, inflation has been running very close to our 2% target. The bank's core measures of inflation are also edging up, as we had expected. Still, inflation in Canada will be influenced this year by temporary factors related to gasoline, electricity prices, and minimum wages. For example, we expected that inflation would drop temporarily below 2% in January, as you can see in the slide that's up on the screen now, because of the effects from gasoline price increases that took place a year earlier. But the decline in inflation, which is just to 1.7%, was a bit less than we'd been expecting, and that reflects a number of factors. Inflation is expected to climb back to around target in the coming months as gasoline prices pick up on a year-over-year basis. So that brings us to our decision that we took yesterday, which is to hold our policy rate, which is a target for the overnight interest rate, at 1.25%. This decision, as always, is grounded in our assessment of developments in the Canadian economy and what they mean for the outlook for inflation. In that regard, global and Canadian economic data have come in pretty much as we expected, and I've talked about some nuances in that in the last few minutes, but I think the broad picture is very similar to what we would have expected a couple of months ago. That confirmation gives us greater confidence that inflation will remain sustainably near our 2% target. Our decision yesterday also takes into account some important context. First of all, our policy rate remains appropriately below what we call the normal or neutral rate, the policy rate which would balance the economy over the longer term. We've estimated the neutral rate to be in the region of 2.5% to 3.5%. I say it's appropriately below that neutral rate because accommodative monetary policy is working to offset several factors that are still weighing on demand. Persistent competitiveness challenges facing Canadian exports, the chilling effect of heightened uncertainty about future U.S. trade policies, the burden of high household debt levels. The second piece of context is that starting last summer, we increased our policy interest rate 3 times for a total of 75 basis points. In these moves, we've been balancing the risk of undermining the economic expansion by moving too quickly with the risk of delaying too long and needing to raise rates sharply later on to rein in inflation. By moving gradually, we've also been able to take in new analysis of the incoming data as they pertain to 4 key issues. First, when an economy is running close to its full capacity, it can actually create more capacity as firms invest and as discouraged workers are drawn back into employment. Second, as I've already discussed, inflation dynamics could be changing in the new economy, and it's important to understand those dynamics. Third, despite strong unemployment gains and an economy operating close to capacity, wage growth has been slower to materialize than might have been expected. And finally, with household debt levels being very high, the economic effects of interest rate increases could be greater than they were in the past. In our deliberations for yesterday's decision, we took stock of recent developments related to these issues. As job creation has absorbed slack in the labor market, we've started to see wages pick up. I mean, I know you've been seeing more of this in BC, but we look at, of course, the national labor market, and there we've seen at least some signs of wages starting to increase, as we would expect if the economy is moving to close to full employment. With respect to the impact of higher interest rates on housing markets and the economy, although it's still too early to make a full assessment, we've seen a deceleration in household borrowing. And while it's also too early to tell how much additional potential output in the economy is being created, last week's strong investment figures are encouraging. We will be providing a full assessment of potential growth as well as of the neutral interest rate in our April monetary policy report, so watch this space. Allow me to conclude. All things considered, we decided yesterday that the current policy rate remained appropriate. While the economic outlook is expected to warrant higher interest rates over time, some continued monetary policy accommodation will likely be needed to keep the economy operating close to potential and inflation on target. My governing colleagues and I will remain cautious in considering future policy adjustments guided by incoming data in assessing the economy's sensitivity to interest rates, the evolution of economic capacity, and the dynamics of both wage growth and inflation. Rest assured that, as always, we at the Bank of Canada will continue to do our part to ensure that we safeguard and build on the progress that has been made so far. Thank you.
Thank you, Deputy Governor, for that. And this is going to signal the start of our question and answer session. And the Deputy Governor has agreed to join us for about 15 minutes on stage here. And I just wanted to remind everybody in the room here that you can still use your mobile device. There are some questions that have been ranked on Slido. And remember, if you go to your handheld device, there's no need to download it. And again, the event passcode is the Bank of Canada 2018, all one word. And I've been watching that. I've got a couple of questions to get us going, and I'm going to actually take some information and bring them together for your consideration. I'd like to start out with 3 things today. One, to thank you for joining us, really for the first economic report. This is a new activity for the Bank of Canada. Mm-hmm. And thank you for also sharing with us the context about the new banknote. I think that's important on International Women's Day to recognize that. And for those of you that don't know, that the Bank of Canada was recently recognized as the Central Bank of the Year. And clearly, your international colleagues believe we're in good hands, and I think that's worthy of recognition, so congratulations for that.
Thank you.
Let's get going with, we were having a conversation over lunch about what I'll politely call the velocity and the fluidity of trade policy making in the White House. And I'm not asking you to comment on that, to be clear, but how do you think U.S. tax reform will affect Canadian competitiveness? If you could give us some context on that.
Okay, well, I mean, U.S. tax reform, I mean, we have noted is, I mean, it is a piece of our economic outlook, and it really is something that, for Canada, it kind of cuts both ways. I think the starting point is it is going to provide a boost to the U.S. economy. You know, it is a cut in taxes, it encourages more spending, more business investment in the U.S., and Canada, as a close trading partner, is going to benefit directly from that. Now, the other side of that, of course, is that you know, you reduce corporate tax rates in the U.S. That kind of tips the scale a bit away from investing in Canada to investing in the U.S. It makes it relatively more attractive for firms that have operations on both sides of the border to put more of their expansion plans into the U.S. And of course, that's one of many factors that firms take into account in those decisions. It's not going to be the only or the overriding factor, probably, but it is something that on the margin is going to tip the scales a little bit in that direction, and that is something we built into our economic forecasts as being a bit of a downgrading of business investment in Canada.
Obviously, still looking at the United States, is there's a significant infrastructure deficit in the United States. The Americans have clearly signaled they're going to begin to address. You know, what's the impact on both goods and services from Canada with respect to American infrastructure spending, the benefits or thereof?
Well, I mean, in general, it should be positive for Canada. Again, I mean, any kind of investment spending tends to have a fair, any kind of U.S. investment spending tends to have a fair amount of Canadian content. Now, of course, the trade measures that you were alluding to could have some offsetting effect on that. So we really have to see what emerges when it emerges and what kind of other conditions are attached to it. But you know, broadly, in infrastructure investment is something that tends to have a positive effect on the Canadian economy as well.
Switching gears, you know, one of the questions that you know certainly comes up in the British Columbia context, and for companies that because we have the most diversified economy in Canada, which is, when we look at our largest export partner in the United States, you know, how do you view, obviously, Canadian and U.S. foreign exchange rates impacting certainly rate decisions, but generally the Canadian economy?
Well, I mean, certainly the exchange rate is an important element in our economic outlook. You know, the exchange rate affects the competitiveness of Canadian exports, and that's one, you know, it's one of the things we build into our models when we're trying to predict how much exports are going to expand. Of course, there are a number of factors driving exchange rates in Canada. We have, I mean, for a long time, I think the commodity price movements were an important driver, and that's, you know, historically, that certainly is the case, and it has been the case, and I think will continue to be. Period really starting around 2000, where the Canadian dollar was being boosted for increasingly by rising prices of oil and other commodities, and that, of course, was posing more challenges for competitiveness for other Canadian industries, including manufacturing and services. But then, of course, the last you know, 3 years or so, we've seen those movements reversed, and the Canadian dollar is now you know, now at a much lower level vis-a-vis the U.S. dollar than it was. I mean, we don't forecast the exchange rate going forward, but I mean, certainly we will take into account any further movements in the exchange rate, and to the extent that they're driven by, I mean, to some extent by commodity prices, then there are some offsetting factors because we're benefiting from the higher commodity prices, but our other industries are probably facing more of a challenge from the effect of the exchange rate. But the other factor, of course, is the relative positioning of U.S. and Canadian monetary policy. And you know, in a setting where the U.S. looks like it's on a stronger growth track or on a track where monetary policy is likely to be tightening more rapidly relative to other countries, then the US dollar strengthens against a whole range of currencies, and that includes the Canadian dollar.
Thank you. That's fantastic context. I wanted to switch clearly in the room here on Slido. Clearly, the number one question is about consumer debt and mortgage debt, and in the context of not only just stopping or limiting rising rates, but just if you have any context you want to provide us with about just really relative to Canadians' higher level of consumer debt and mortgage debt impacting future rates, and how the bank views that.
Well, I guess for that I might go back to something I said in my and it's I think to a large extent it's a financial stability issue. It's the fact that that when you have a very high level of household indebtedness, then it means that any adverse shock hitting the Canadian economy is more likely to translate into sort of stress in the financial system, and that's something that really for several years now we've been drawing attention to. But you've been asking about the implications for monetary policy, so I'll say something about that. And we're not using monetary policy explicitly as a tool to address that situation, but it does have a bearing on the balance of risks I talked about, because I talked about how when we're thinking about monetary policy, we're balancing the risk that we might move too quickly and actually have too strong a dampening effect on the economic expansion versus the risk that we delay too long and have to raise rates too quickly later on in order to get inflation back on track. And both of those risks are actually influenced by the level of household indebtedness, because on one side, with higher household indebtedness, then it's possible that a given increase in interest rates could have a bigger effect on the economy. So that's a reason for moving very cautiously, and it's a reason that we've cited as being a factor that we're watching as we go along, to make sure that we're not sort of overdoing the increases in light of the effect that it might be having on the households. On the other side, of course, it would also make it more concerning to have a very sharp increase in interest rates if we had to do that in response to what was happening to inflation. So it's something we certainly think about, and it's an important factor in the background.
Thank you for that. And clearly, in parallel, there's a couple of questions that have come about debt to GDP the ratio, and really, again, the question on Slido here is about the lower marginal benefit of increased debt impacting decisions. Currently, our federal government is running I think in economic terms, a modest deficit. Others might say it's larger than that. But obviously, looking at if there's a shock to the economy, how well is Canada positioned to respond to an economic shock, given our debt to GDP ratio?
Well, I think we're generally well positioned in most respects that are relevant. I think the fact that the governments generally have relatively low levels of debt, so they have more room to expand with fiscal policy if we did have a negative shock. Mm-hmm. The fact that our financial system is still very resilient, and so we'd be less likely to suffer the kind of financial fallout that we saw in many advanced economies 10 years ago. On monetary policy, we do have room to maneuver, and so we have because rates are we still have room to both through conventional and unconventional policy. So we still do have a number of tools on a number of fronts that would help us to respond to a shock.
Again, thank you for that. And wanting to switch gears to talk about trade for a second as well. I'm curious, when we look at, we at the Board of Trade like to say politics is local, but trade is personal. And it really is about sitting across the table from someone. At the end of the day, there's a TPP meeting today in Chile.
Yes, right.
Absolutely. And when you look at a potential Canada-UK free trade agreement to the future, how do you think, obviously we look outside of NAFTA, that trade agreements could really benefit the Canadian economy?
Well, certainly I think the experience in the past has been that these trade agreements have benefited Canada, but often in quite complex ways. And certainly every time there are winners and losers. There are sectors that expand and become to a scale where they become more efficient. Other sectors that turn out not to be able to compete in a more open sort of economic environment. And so we'd expect to see a similar structural adjustment taking place with any change in our trading arrangements. And that's true when you talk about a new trading agreement where we open up trade to some new economies. It's also true when you think about scaling back trade agreements or something like that, which is the fear that people have with regard to NAFTA. So, I mean, this is one reason that we're focusing so much on the channels through which trade arrangements are affecting the economy, and it's very difficult to give a prediction of how things will evolve without knowing a lot of details about how the arrangements are changed.
Well, and I think back to your earlier comments about the fluidity of the situation is obviously
that's right,
unique in the world.
With regard to NAFTA, I think people. I think there are a number of concerns out there, and certainly there's quite a wide range of possible outcomes, but how those what specific outcome there is would have make a lot of difference to how to what both the magnitude and the timing of the impact would be. So that's something we're watching very closely.
Well, I think of note for those of you that noticed the federal budget, that the federal government is actually forecasting a reduction in tariff revenues as we go into some of these trade agreements. So the orientation of our federal government is to obviously pursue trade agreements. Wanting to switch gears again, and this is a question that's coming to us. British Columbia's economy is made up of 98% small businesses, and we have 5,000 members that we communicate with quite regularly. And with respect to, we talk about wage growth and some issues there. I'm interested in your thoughts about when we look at increases in the minimum wage, obviously, in a number of jurisdictions. You've also got increases to the CPP and a new payroll tax here in British Columbia. And just wanting to know what, we obviously look at employment numbers, but really how you see that manifesting itself in employment, because obviously small business owners are going to have to make a decision about whether they, how they absorb those costs, either by increasing prices or reducing their headcount, the number of employees.
Yeah, I mean, certainly those are policy measures that, they don't fall within our sphere of responsibility, but of course they do have an economic impact. And I think economists generally, maybe first mentioning the minimum wage changes, in general, economists have analyzed those things quite a lot internationally. And the general finding is that they have a mix of impacts. They do boost the incomes of those receiving the higher minimum wages, and that can generate more spending on certain things, which can then provide support for economic activity. On the other hand, clearly they do have the effect of pricing some workers out of employment, and so which mix of those two effects, and the fact that some of the consequences may be passed on to consumers through higher prices, can also have an important effect on what the ultimate outcome will be. So of course we build in some assumptions about how the current the recent changes in minimum wages will affect inflation and employment. Those are of course provisional. They're based on historical experience. And we'll be watching how things evolve as we go along to see what the actual impact is. On the small business taxation, of course, again, it's not really our sphere, but I think maybe I'll go to the more general issue of competitiveness and the fact that I think I mentioned earlier when I was giving my speech that this challenge of competitiveness that Canadian businesses have faced is something that has been dampening Canadian exports for quite some time now. Really, it's not something that's new this year. It's something but it is something that is affected by a number of things, including probably taxation, regulation, the exchange rate, and a variety of other things. And I think we can't say we've sort of got to the bottom of what the key factors are, but certainly this is something our staff have been analyzing in quite a lot.
Well, and thank you for that. We're going to conclude our question and answer session because you actually answered the second question in Slido there.
Okay.
And so thank you for that. And ladies and gentlemen, if you could join me in thanking the Deputy Governor for his time today here to address the business meeting.
Okay.